Let's take another look at Shopify shares. The company projecting sales in the current quarter that just met expectations. The fear here is, of course, that these U.S. tariffs are going to weigh on growth, especially if they increase the cost of goods that merchants bring in from China. Let's get more on those results from Angelo Zeno, Senior Equity Analyst at CFRA Research. Angelo, anything that jumped out in the latest quarter or forecast from the company for you?
Yeah, so thanks for having me, Andrew. I think overall, results from what we saw look pretty good. I mean, they grew top line at 27%. We were looking for 25%. The guidance mid-20s growth. We were looking closer to low 20s growth at around 22%. So, I'd say that on the top line, it looks pretty good. They actually cited going into April and May from what they've seen thus far this quarter. The trends remain pretty favorable, so they haven't necessarily seen the impact from tariffs, at least at this point in time, or at least not something that's going to hit the business yet. And then I'd say the other key metric that investors have been looking at lately has been the free cash flow number. You're looking at free cash flow as a percentage of sales, 15% this quarter, and up from about 12% last year, and that kind of continues to point to the mid-teens outlook that they're expecting here over the next couple of quarters, and it's them essentially managing or balancing the spending with the growth objective that they have, and it's at a very healthy pace, something that we didn't see in prior situations like in 2022. So we think that the health of Shopify today is much better than we've seen in the past.
Now, I haven't had time to check their balance sheet this morning, but they did have net cash when you back out any debt of about $4.5 billion prior to this report. So they got a pretty clean balance sheet, to put it mildly.
Yeah, I mean, a very clean balance sheet. You look again, and then you look at the free cash flow growth. Again, that's really important. And we're looking at, because of the scalability of this company, the top line growth that you're seeing. We're looking for free cash flow to grow at least 25% on an annualized basis here over the next 2 years. So it'll slightly exceed that of revenue growth. I'd say maybe the one negative that we did see from Shopify in terms of the guidance and maybe what's hitting the stock a little bit is the gross profit, the gross margins are being constrained a little bit. So we are actually seeing gross profits grow slower than actual revenue growth. And a big reason for that actually has to do with the mix of the company. They're seeing a lot more momentum on the payment side of things. It's actually something that they've seen here in the past. But the fact that the margins are somewhat constrained from that perspective is something that has held the stock back here, I think, to an extent. And, typically, if you're a tech investor, you usually, with a platform-based company like this or a software-oriented company, you do want to see more elevated margins being sustained.
Now, in terms of operating earnings per share, they're profitable, according to your analysis. They made $1.55 on that metric last year per share, US. You see that falling, the last I saw from you, slipping to about $1.45 this year, Angelo?
So, we haven't updated our numbers at this point in time, but, overall, when we look at operating profits, and maybe that's more important, operating margins are expanding, and we do expect operating profits to continue to increase in 2025 and into 2026. But there are also one-time charges that did hit this quarter as well. Again, it was non-GAAP oriented in nature, but on a going forward basis, when you actually look at the operating margins, they are expanding on a year-over-year basis, and the actual profits on a non-GAAP basis continues to go up.
And the tariffs, of course, are an unknown quantity, but would a lot of their stuff come into the U.S. market from China and other Asian locations?
Yeah, so there were a couple of concerns going into the call, which they did address. One was kind of that de minimis exemption with expiring, kind of that loophole expiring. They actually said that there wasn't a meaningful impact there to sales, only about 1% of their revenue. Basically, goods tied from China going into the U.S. that were lower priced, and then also something along the lines of cross-border merchandise value being about 15% of the sales. only half of it kind of involving the U.S. So when you actually start seeing kind of the cross-border merchandise value, also not a huge impact. But listen, tariffs are a concern for a number of indirect reasons for Shopify, and clearly when you look at Shopify, they are more tilted to small and mid-sized businesses, right? So we have to see what the impact is going to be from a macro perspective going into the second half of the year. There is definitely uncertainty out there. I think that's also a reason why the shares have performed the way they have as of late. So the street is discounting that to an extent, and we do believe you're probably going to see sub-seasonal growth, or at least you should expect sub-seasonal growth going into the second half of the year. We are projecting that revenue will decelerate throughout the calendar year because of the uncertainty tied to tariffs at this point in time.
Now, the stock trading in U.S. funds at around $91 today, down almost $4. Last time I checked, your 12-month target, Angelo, was $150 U.S.
It is, and again, we haven't placed an update on it post this call. I will say this though: when you look at the valuation of Shopify, and you can't use a direct PE approach, obviously, because this is a much higher growth-oriented company. They are sacrificing profits to an extent to invest aggressively in the company, something that Amazon did for 2 decades plus. You look at this company; they are growing more than 2x the broader e-commerce space here over the last year plus. So you kind of look at the valuation. We use an EV to sales valuation. It is trading at the lower end of its range. It's got a wide range of, let's call it 5 to 50 times. It's trading about 10 times next year. So we think, given the growth that you have tied to this company and the valuation from that perspective, we think it looks attractive here.
Angelo, thank you very much indeed.
All right, thanks for having me.
Angelo Zeno, Senior Equity Analyst at CFRA Research. Coming up,